Hey guys, this is Ajay and welcome to Accounting with Ajay. Please watch the previous video if you need a simplified introduction on material variances. So let's do a comprehensive example for material variances in this video. So let's start. So we have an example here. Amber Limited is a mango jam producer. Okay, fine. The standard cost card with respect to the direct material cost is as follows. Let's have a look. Direct material cost per unit. 2 mangoes at $1.5 per mango. Then the total cost is $3 per unit. Sounds good? Amber Limited produced 1,000 bottles of jam last year with a direct material cost of $3,800 and they purchased and used 1,900 mangoes. Bit complicated. So let's check the requirements. Required. Calculate the direct material price variance. The second one is calculate the direct material usage variance. And the third one is calculate the direct material cost variance. So let's start doing this. So we have to reorganize the question. So company needs 2 mangoes to produce each bottle of jam. And they have planned to pay $1.5 per mango. Therefore, the standard direct material cost per bottle is $3. However, the company produced 1,000 bottles of jam with a direct material cost of $3,800 for 1,900 mangoes. And we have to calculate direct material price variance, direct material usage variance, and the direct material cost variance. So let's start with the first question, calculating the direct material price variance. The actual material cost for 1,900 mangoes was $3,800. However, according to our standard, we had expected to pay $1.5 per mango. Therefore, according to our standard, the direct material cost for 1,900 mangoes must have been $2,850. Therefore, the direct material price variance is $950. And since the actual cost is more than the standard cost, it is an adverse variance. And as we know, it is denoted by A. It stands for adverse. Guys, you would have noticed a point here. We have used the actual materials or the mangoes to calculate the total standard cost and the actual cost. We have never used the production volume because we simply consider about the standard and the actual cost for actual material usage, that is the actual mango usage. We always use quantity or actual hours whenever we calculate the price-related variances such as material price variance, labor rate variance, and variable overhead expenditure variance. Actually, we will be talking about labor rate variance and variable overhead variance in future. And we shall concentrate on material price variance now. So let's start answering the second question, that is the direct material usage variance. We used 1,900 mangoes to produce 1,000 bottles of jam. However, according to our standard, we had expected to use 2 mangoes to produce 1 bottle of jam. Therefore, according to our standard, the direct material usage for 1,000 bottles of jam must have been 2,000 mangoes. So we used 100 mangoes less than the standard usage of 2,000 mangoes for 1,000 bottles. Wow, that's superb. Therefore, the material usage variance is 100 mangoes favorable. As we know, we cannot keep it as 100 mangoes and we need to multiply it by the standard material price of $1.5 per mango. Therefore, the material usage variance is 100 multiplied by $1.5, that is 150 favorable. So guys, now we have calculated the direct material price variance and the direct material usage variance. As we are aware from the previous video, the sum of the direct material price variance and the direct material usage variance is equal to the direct material cost variance. And the direct material cost variance is the difference between the standard material cost for actual unit produced and the actual material cost for the actual units produced. In our example, the standard direct material cost for 1 unit is $3. That is 2 mangoes per unit multiplied by the standard price of $1.5 each. So the standard direct material cost to produce 1,000 mangoes is $3,000. However, the actual material cost is $3,800 for 1,000 units. Therefore, the direct material cost variance is 800 adverse. And as we know, the sum of direct material price variance and the direct material usage variance must be equal to the direct material cost variance. In our example, the direct material price variance is 950 adverse and the direct material usage variance is 150 favorable. Therefore, the total of 950 adverse and 150 favorable is 800 adverse. That is equal to the direct material cost variance of 800 adverse. Okay guys, we are at the end. I trust you have understood the direct material variances clearly. If not, please use the comment box to clarify your doubts. I will reply to you at my earliest. And there's an exercise for you in the link given below. Please calculate the variance given in the exercise and share your answers in the comment section. I will give you individualistic feedback on your answers. So we will meet soon with labor variances. Till then, see you.